May I remind you that trading is risky and not suitable for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Welcome to QuantBox Daily, Friday, October 14th, about 40 minutes before London Open. So yesterday, you probably had a fun trading day. If you were trading the Aussie USD or the Aussie Yen, we observed this yesterday morning saying, don't want to sell down here, but you want to look for some solid bullishness to confirm a buy. Now, you can see yesterday getting that whipsaw, dropping straight down into that profit-taking zone and then popping straight back up. A challenging trade to take for sure. One thing's for sure, though, we'll have a look at the bullishness that you may or may not have seen. We absolutely were 100% accurate in saying, do not sell down here. Now, I think there are two traders in the world, right? There are the traders who counter-trend trade, and there are the traders who don't. One of the things I mentioned yesterday was that one of the only counter-trend trade that Wayne will take is if price at the end of the week is down here, and on the sort of Asia of the Sunday, taking a short-term buy up to the central, or if price is up here, taking a short-term sell down to the central. That can be in a weekly time frame or a monthly time frame. Okay. We also mentioned, I also mentioned that counter-trend trading is very dangerous because of the fact that when news comes out, like we saw yesterday, this happens. You got to decide what level of control you want to have in your trading. Do you want to focus on your fundamental bias and stay true to your fundamental bias and recognize that sometimes you're not going to be doing anything in the market because you're waiting for opportunities to sell at a level of resistance where price is bearish? Or do you want to circumnavigate that control and decide that you'll take a chance on potential profit taking? Now, which one's better? Well, that's absolutely up to you. All right. That depends on your business model. In terms of identifying potential bullishness, if we had to use the H4 time frame, and again, I spoke to you guys about this yesterday. I said my way of trading is identifying what I call bullish or bearish integrity, which is basically in a trend, it's a role reversal. In a range, it's top or bottom of the range, identifying that prices closed at some level of integrity. So for example, let's just say price came up to this resistance over here. All right. Hit that resistance and price was then bearish. I would call that bearish integrity. What this means is this is a level of resistance that's currently unbroken and quite pertinent to this bearish trend. Okay. If price did this, well, then I see what was resistance becoming support. And that's quite a different situation, okay? So if you look at the daily time frame, do you have, besides this MS1, remember yesterday we didn't have that, we're just sitting over here. So do we have any kind of price action, any moving averages, anything on this time frame that indicates I'm in a place to buy? Again, look at last week, taking the trade, and you can see it didn't really reach the central pivot point. That's fine. It came just shy of 14 pips shy, but that's an example of a counter trend trade, right? Price is below that central, take price up to the central, and then sort of a profit taking counter trend scalp, if you will, a bit more than a scalp, a couple of pips. Okay. Sometimes it reaches target, sometimes it doesn't. However, you can see here, taking that counter trend trade, not viable. Now, of course, there's a reason for that because you can see that at no point had price broken resistance and a resistance become support. So at no point have we had any change in fundamental bias on the Aussie dollar USD. It's still a sell, right? Everything still says bearish. But we spoke about the possibility of taking a counter trend trade. Now we can see yesterday we're over here, now we're over there. So our strategy was correct. We don't want to sell down here. This is a place where bears can potentially get out. Whether they're getting out for the next 3 months, or they're getting up for the next week. That's still to be determined. But the fact is that we were correct about not selling here and identifying this as a potential place where price can suddenly come up. The question is, just because we identify that doesn't mean that it's a safe place to trade. We still said counter trend trading is a very dangerous business. So what do you do as a trader, right? You can see here, very challenging situation over here in terms of this low volatility, price then dropping down, price then coming up. If you were looking for a buy, you can see there, that's where price is closing at that support. Does that mean that this is going to go up and up and up and up and up? No, it simply means that at this point in time, we've got price closing at support. Price can come up, sort of revert to neutral, close at resistance, and continue going down. So how do you avoid those things? How do you avoid situations where, you know, you're buying, then you're selling, and you're buying, and you're selling? And the answer is stick to a fundamental bias. And maybe that's the level of control you need to have in your trading, where you realize, you know what, this is where it begins. But it comes with sacrifice, because there are going to be times where you're not going to be trading. Oh, snap, did I just close that? Where you're not going to be trading. So if you look at this week from a perspective of, I'm a bear and I'm looking for opportunities to sell, you're waiting for resistance. There's resistance, there's resistance, there's resistance, there's resistance, there's resistance, there's resistance. And you're looking at this and saying, right now, I'm not going to do anything with this. I'm waiting for that pullback. I'm waiting for that opportunity to sell. And I'll only look at buying this at such time as my fundamental bias has changed. That is the most controlled form of trading you can have, right? Because it means that at no point are you going to be in a situation where you suddenly find yourself trading against the fundamentals and then price, you know, suddenly drops because a news event comes out. So for you, if you were sticking to your fundamental bias this week, would have been nothing to do. You would have been chilling, waiting, taking the week off. Or you're looking at this chart and you're saying this is a place where price can potentially reverse. And maybe somehow you managed to avoid trading inside here because you didn't see any indication of bullishness. Very difficult to navigate this. And then somehow when price came all the way down here, you recognize that as bullish. I'm not sure how you do that consistently. Like, what's your indication that this is going to be going up? I don't see price closing at supports. Perhaps you're in over here. What I think makes the most sense is sticking to this. I think this is going to give you a lot more control and consistency in your trading. But again, focus means sacrifice. So you look at euro dollar right now, we got a strong sell. Okay. There is absolutely no reason to be long euro dollar, just simply based on the fundamentals. But does that mean that right now you're looking at your chart and saying, all right, let's sell at this moment in time? How many traders right now looking at this 21 thinking I'm going to sell there? How many traders aren't realizing that if they want to sell at this 21 EMA, what they're trying to sell is a lower high? How can they sell a lower high if this is not a lower low? Recognize that right now, if lower lows produce lower highs and lower highs produce lower lows, this is not a lower low, which means this is not a lower high. So we got some profit taking, price came up, price came down, higher low, some consolidation going on here. So what do? Well, your choices are, you look for some short-term opportunities to sell this and some very sketchy price action, or you realize that right now, we're not in the best situation to be trading euro dollar in line with our fundamental bias, completely sideways and in a really strange range, right? Traders up here trying to take it down, traders over here trying to take it up. This looks like the middle of a range. Even though you haven't got a textbook stock standard range over here, look at the structure. Look at the story that price is telling you. It's not saying trend. Okay. So we wait. We wait for the situation to be much better. And you recognize that that behavior until now has made you a ton of money as prices come down. That same discipline, following your fundamental bias, continuing to trade, this trend, gorgeous trend, tons of money going on here. Now suddenly things are not so interesting. Okay. Looking back, look at how every lower low makes that lower high, you sell. Lower low makes lower high, you sell. Lower low makes lower high, you sell. That would have made you money. Over here, something else is going on. Pay attention to that. Or ignore it and have some very, very high volatile trading, right? It's more than just price being at dynamic resistance. Ultimately, you want to trade trends because that's where you're going to make the most of your money and lose the least of your money if you can do it correctly. Pound dollar, still bearish. Look at a pound dollar chart. You can see here, look at how prices break to the 21 EMA. Why? This is not a lower low. How can there be a lower high if there's no lower low? Consolidation. Now, there are traders out there who try to be smart enough to say, I'm going to try and trade this and figure this out. Why? Does this look like optimum selling situation? No, it does not. Where is your long-term bearishness? Where's your lower low, lower high, lower low, lower high? Where's that? You know, I'm going to get in and make some nice money and without risking losing money based on the structure of the chart. And you can see there, this does not look like optimum bearish conditions. Okay. Traders might be falling in love with daily M3 and whatever else. Just take a moment, take a step back from the pivot points and just look at this chart of here and tell me, does that look like something you want to trade right now? Or is this something you have to figure out? Try and outsmart the market. Why do you want to outsmart the market? Why not just wait for opportunities when everything looks good, makes sense, is flowing correctly, and you're not sitting in some kind of consolidation, which messes up your psychology, where you got to get in and get out quickly and then jam your stops and like all this kind of weird stuff that's going on that completely messes up your consistency. All the money you made over here, taking this down, surely that capital is precious to you. The same discipline and control you had all the way down, right now you should look at this and say, that does not look like something I want to trade. Now, of course, you could go daily. You could then go to the H4 time frame and say, okay, well, have I got something on here that's worthwhile trading? You could say, oh, there's nothing here. Is there something over here that's worthwhile trading? Or you could use a higher time frames to guide you. Taking a look at the next chart. USD CAD. Still a buy. Technically. Not looking great, is it? Not looking great. That looks like a lot of hard work. If you're getting in over here, you got to make sure you get out over there. You got to really be on top of your game. Or you can look at the daily time frame and say, I don't see anything to do with this right now. That's a lot of consolidation, a lot of sideways movements. But I'm a bull because of my fundamentals. Okay. Looking at Aussie USD. We looked at this one already. It's still a sell. Look at that daily time frame on Aussie USD. Do you see yourself at resistance right now? Do you see yourself at a place where you can exercise that bearish bias? No, you don't. So you wait. Which you would have done in all the situations with price coming down, and it would have paid you very, very nicely. Okay. Kiwi dollar was neutral yesterday and the day before. We've seen quite a bit of neutrality, still neutral. Okay. We can keep watching that. Aussie yen was bearish yesterday. It's still bearish. Let's take a look at Aussie yen. Also one of the pairs we were looking at, saying that if you wanted to counter trend trade it, you were in a place to do so. Also, look at that whipsaw. Okay. So our recognition of this being bottom of the range was correct. Our analysis of that was correct. So we're like, okay, cool. So good idea to stop selling this. Thank goodness we had, in addition to the bottom of the range, if you couldn't see that, you had the profit taking zone. It said, don't sell down here. Okay. Now price all the way up. Now, if you got into this trade, you could have taken this trade, you could have survived this trade, but you would have had to have a very wide stop. So you got in over here, and your stop was below sort of 70 pip stop. You would have survived this. But if you actually look at the chart and say, hold on a second, like on my daily time frame, do I actually have any indication to sell this, seeing as my bias is bearish? The answer is no. You would have stayed out of the trade and you wouldn't have lost any money on that whipsaw. But that doesn't mean you couldn't take this trade and you couldn't find a way of taking this trade. You couldn't have a wide enough stop to take this trade. But my question is it really worth it? Chances are you got knocked out. And now looking at this and saying, okay, Kwame, are you falling in love with the idea of buying? Remorse trading. And in the meantime, what you could be doing is saying, okay, hold on a second. Whoa. Let's start here. My bias is bearish. Okay. Am I currently at resistance in a place where I can sell this? Now, you might be saying, oh, moving averages. They're not moving averages. They're just lines in the chart right now because this is sideways. Okay. You need to know how to use your dynamic resistance and support. 21 and 55s are useless in a sideways market. Might as well delete them on this time frame right now and put them back when it makes sense. But currently, presently, are you at a place where you can sell? Well, if this is a range, then are we at the top of the range yet? Okay. Could we come back down? Sure. Is that a long-term trade, short-term trade? I mean, ultimately, if we look over here, you got price this resistance over here. Okay, price broke this resistance. It didn't become support, so price is currently neutral. And you're all the way up there. Okay, cool. So that's a 15-minute chart. So if you could look for resistance areas to take a day trade, but you definitely are looking for price action to confirm that on the 15-minute time frame. So how you structure your strategy is up to you. You could just be, first you must find something on the daily, then you move down. Or you could say nothing on the daily. Do I have something on the H4? Nothing on the H4. Do I have something on the H1? It's up to you in terms of how you want to structure that. You could also be short-term long, long-term short, but you can see how as we increase the frequency of our trading, we start to lose more and more control of our trading, which means we take more and more risk, which means we face more and more potential losses. If you have good control, then you'd follow your bias and say, right, I'm only looking for sells. And am I at a place right now where I could sell? And take it down accordingly. It's up to you in terms of how you build that. You got to decide what kind of trader you are. But I think the more control you can have, and it's a balance, because you don't want to have so much control that you have such little frequency you just don't trade for a while. But sometimes you might find yourself not trading for a while. Okay. Last week would have been a great week for you. This week would have been like, no, I'm not going to go and lose capital I made. Because that's the worst thing, is like, it's not just about getting into the trades. That's one element of it. It's about people who make $10 today, but they lose 50 tomorrow. Okay, so our other yen pairs, we've seen neutrality this week, and that continues. Okay. So we really, your decision this week right now is if you're in the Aussie yen trade, and you did manage to survive the whipsaw yesterday, and you're in at this profit-taking zone and you're looking for price to head up, your target is, let's see. Oh, you've already exceeded your target. Your target was over here, weekly central. Okay. From there to there. Beautiful. So our strategy of like price is going to come off of this and be up here by Thursday. Okay, fine. So by Friday, we got there. But trading this was dangerous, right? It had happened in the end, but it was dangerous. Now, if this is fundamentally bearish, would it not be easier to wait for resistance? If you did take this trade, well, then you're currently out and you're waiting for opportunities to sell. Or you didn't take this trade and you're still waiting for opportunities to sell. Or you're doing nothing. So I think this weekend, if you go back and look at your trading for the week, ask yourself, how often were you following your fundamental bias? What trades did you take? And if you lost those trades, if you were buying, go and look on the charts and the various time frames and see if you bought and you lost, that means that somewhere you were trading against the bias of price or the fundamental bias. So if you bought Aussie yen and you lost, well, chances are you can say, well, okay, I was buying when it was fundamentally bearish. That's a good thing to avoid in the future. Or you were buying in a place where price wasn't bullish. Okay. Or you traded outside of a market open, or you didn't identify that price was bearish in a lower time frame. Go and find why the loss took place. Go and identify what caused that loss. And it's something on the chart that you didn't see, or it's something that you went against in fundamentals. Go and have a look and see where it is. Make a note in your diary. Bring it to the stop, look, and correct session next week. We can go through it together and look at it together. What's important is that you spend the weekend reviewing your losses and saying, right, so what can I do differently next week? What forms of control should I bring into my trading that will avoid this inconsistency in the future? It's kind of like making a cup of coffee, right? The first one's bitter, so then you add less coffee, or do you add more sugar? The second one's too milky, so do you add more water or do you add less milk? And so you continue playing around with these ingredients until sometimes you find the perfect cup of coffee. But maybe the perfect cup of coffee requires a specific type of milk that you can't get every single day, or a specific type of bean that you can't get every single day. And so you realize that for the perfect cup of coffee, I can't have it every single morning, but I can have it once a week or twice a month or 3 times a month or whatever the case may be. But that's a decent cup of coffee that you want. Or are you okay with just sort of saying, sometimes I'll like the coffee, sometimes I won't, it's not really consistent? What level of control do you want to have in your trading? What changes can you make next week that'll bring about better results? All right. Also, one thing you could do is go back and simulate this week and retrade it. But this time, so first review your trade, see the mistakes you made, then go back and simulate it, but then correct those mistakes. So your brain won't know the difference. And so you start enforcing positive behavior as opposed to leaving negative behavior unchecked and unchanged. My view in terms of what I'm going to do is I'm going to stick to a high level of control of my trading, which means fundamentals first. If the fundamentals say bearish, I'm looking for resistance. On the daily time, on the daily time frame, am I at any level where I could look at selling? Now, what's important is recognizing in terms of the previous day, have I closed at a place where I could perceive resistance? No. Okay. Is there any opportunity on an H4 time frame? But as I get lower time frame, my trades get short and shorter term. So for example, I can see the prices come up, come up, come up, come up. There's resistance over here, 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 a number of levels of resistance heading up here. Okay. So as price goes up and as candles close, I could then be looking at an M15 chart and saying, okay, well, give me some indication of bearishness. I could be saying, okay, well, I don't see anything on this time frame. What do I see in H1? Well, now I've got an addition of daily pivots. I've got a few more levels. And so as price gets up to these levels, again, jump into an M15 chart. If I see the lower low, lower high, double top situation, whatever indicates that we're no longer bullish, we're now bearish, I could take that. But I'm aware of the fact that as we go lower and lower time frame, the duration of those trades becomes shorter. Okay. Unless, so if I get the trade from a daily time frame, if I'm like over here, like, wow, look at that. Then I take this and I just sort of look at it through the time frames and say, okay, is everything still bearish? Is everything still bearish? If I got the 15-minute, okay, cool, I'll take that trade. But now I'm going from monthly to the M2, M4 to M2. Okay. Whereas if I'm doing it on weekly, I'm going from the M1 to the central. If I was buying that, for example, or from the M4 to the, where was it? Weekly M2. If I was on the daily time frame and I was taking a trade, then I suppose you could say, now again, I mean, I wouldn't be taking a trade from the profit taking zone up to the daily central, because to me that's a weekly to weekly. But if I was trading daily pivots, you could say, let's just say somehow, or I mean, you can see here, you get in, if you got in over here at this M2 and your stop was 50 pips below the S1, just like sort of down here, you definitely survived this whipsaw. And then your target was that over there. However, again, you're actually doing an weekly M1 to weekly central. Okay. But you could have been taking a day trade. You might have been ignoring this other time frames and saying, okay, well, it's cool. I'm doing an M2 to M4. Price doesn't hit the M4. Next day, you move the TP up to the next M4, and boom, today you hit the take profit. So you can look at different time frames, because you're getting different candles in different time frames, right? Just because this daily candle isn't showing you anything doesn't mean there's no trades there on lower time frames. But you got to decide, the more control you have in your trading, the less likely you are to lose trades. But remember, your frequency will be affected by that. It's a very careful balance. But ultimately, something has to start with bias. And this week we said the bias is bearish, but you recognize there's a potential counter trading opportunity here. So short-term long, but still long-term short. So what are you doing with it? And where do you see it going? And how do you plan it? And how do you execute it? All right, so give that some thought this weekend. Go do some homework. Go to your journal. What type of trade are you? What are you going to bring into your trading next week? If things aren't working for you, make some changes. If you're not sure what changes to make, bring all your data to the Stop, Look, and Correct session next Tuesday, and let's go through it together. But you can see that if you stuck to a fundamental bias, your life might be a lot easier. I think you'd find yourself being right a lot more of the time. And if you're still losing money, then we've got to recognize how you can technically identify resistance or support, and then technically confirm bullishness. Well, in the case of resistance, bearishness; in the case of support, bullishness. But at least you'll know what you're looking for based on these fundamentals. You're not looking at the chart going like, oh, what should I do? Should I buy? Should I sell? What am I like? Am I going up? Am I going down? Am I at M2 or M3? Like, oh, what should I do? Like, give that some thought this weekend. And if you still haven't got this tool, do yourself a favor, definitely get this tool. Okay. If you like the video, subscribe, click like, click the bell, do whatever you got to do on YouTube, or don't, whatever. Totally up to you. But these come out every single day. And I think they are very helpful. I thank you for your time. To those of you who stayed out of the market this week, well done. To those of you who got in and verified the trade and took profit, well done. To those of you who got in, verified the trade and lost the trade, well done. To those of you who lost the trade because you moved your stop, or you closed too early, or you closed too late, or you chased price, there's work to be done. Okay. Doesn't matter what your plan was. If you had a plan and you executed it and you stayed true to that plan, you had integrity in your trading, whatever the outcome, win or lose, doesn't matter. What's important is that you traded according to a methodology. You traded according to controls. You have to have that in your trading. Now, you might adjust those controls, but at least you had discipline. At least you had integrity. Thanks for your time, friends. Have a nice day.